Hi students, welcome to Sunil's tutorial. I'm Sunil Birwani and today we'll be doing this chapter called as leverages. Let's see this. I'm doing illustration 1, page 218. Should be approximately around there. They said that find the leverages for the following data. So the first thing that you have to do is make your table. Sales less variable cost will give you contribution less fixed cost will give you EBIT less interest will give you EBT less tax will give you EAT. Right? Now let's see this. They give you sales is 50,000. Sales is given to you as 50,000. Variable cost is given to you as 60%. 60% means 60% of 50,000, which is going to be 30,000. Which is going to be 30,000. Contribution is going to be 20,000. Fixed cost is given to you as 12,000. So your EBIT will be 8,000. Right? So in this case, they've asked you to find out operating leverage. Operating leverage is given by the formula EBIT upon contribution upon EBIT. Contribution upon EBIT. Contribution is 20,000 divided by EBIT 18,000. So that's 20
so
and 8,000. Sorry. Somebody 2.5. So it's 2.5. Done. Next, let's see the third sum, guys. Can you please see the third sum? You will see illustration 3, page 290. Let's make the table first. Sales less variable cost gives you contribution less fixed cost gives you EBIT less interest gives you EBT less tax gives you EAT. Right? Let's see this. They have directly given you that your sales is 9,60,000. Variable cost is given to you as 5,60,000. Right? So in that case, your contribution is going to be equal to 4 lakhs. Fixed cost is given to you as 2,40,000. So in which case, your EBIT will be 1,60,000. Interest is given to you as 60,000. Right? So your EBT will be 1 lakh. Tax is given to you as 50,000. So your EAT will be given to you as 50,000. Fine, we get this in here. Now they have asked you to calculate all the three leverages. Right? First, operating leverage is nothing but C upon EBIT. C is 4 lakhs upon EBIT 1,60,000. Someone please work that out.
2.5.
Right? Next, financial leverage. Financial leverage is nothing but EBIT upon EBT. EBIT is 1,60,000 upon EBT 1 lakh.
1.6.
And then combined leverage. Combined leverage is nothing but contribution upon EBT. Contribution is given to you as 4 lakhs divided by EBT. EBT is given to you as 1 lakh, so 4. Right? Straightforward calculation of the three leverages. Right? Next, let's move on ahead. Let's see sum number 4. Let's see illustration 4. Let's make the table first. Sales less variable cost gives you contribution less fixed cost gives you EBIT less interest gives you EBT less tax gives you EAT. Let's see this sum. They said that calculate the degree of the leverages for the following data. Sales is given to you CPU TC. Sales is given to you as 1 lakh units. Sales is given to you as 1 lakh units at rupees 2 per unit. So that will be 2 lakhs. How do I get TC? CPU into units will give you TC. Variable cost is given to you as 70 paisa per unit. 70 paisa per unit, that means this is going to be 70,000. In which case your contribution is 1 lakh.
1.3.
1,30,000 and 1.3. Fixed cost is given to you as 1 lakh. So in that case your EBIT will be 30,000. Next, interest is given to you as 3668. So in which case your EBT
26332.
26332. They haven't given the tax rate, so that's what they've given you. Let's calculate the leverages, operating leverages. C upon EBIT. C is 1,30,000 upon EBIT. EBIT is 30,000.
4.33.
4.33. Then you have operating leverage, then you have financial leverage. Financial leverage is nothing but EBIT upon EBT. Someone do this
1.14.
30,000 divided by 26,300. 1.14. Combined leverage. Contribution upon EBT. Contribution is given to you as 1,30,000 divided by EBT. EBT is given to you as 26,332. 4.93. So simple, straightforward. You make the table and you calculate your three leverages. Next, let's see some number. Let's see sum number 9. Let's see illustration 9. Again a straightforward sum. They've given you that compute the different leverages from the following information. Sales less variable cost gives you contribution, less fixed cost gives you EBIT, less interest gives you EBT, less tax gives you EAT. Right? Let's see this. Sales is given to you as 2,200 units. In terms of units, they've given you 2,200 units, CPU and PC. Interest is 22,000. Interest is 22,000. Sales is given to you as 2,20,000. Next, they've also given you that the variable cost is 1,10,000 and fixed cost is given to you as 66,000. This is the data given to you in the sum. Now you can start calculating. This is going to be 1,10,000. This is going to be 34,000. How much?
44.
44,000. So in that case, this is going to be 22,000. Right? They've asked you to calculate the three leverages. So I can say EBIT. Operating leverage is contribution upon EBIT. Contribution is 1,10,000 divided by EBIT 44,000. 2.5. Next, financial leverage. EBIT upon EBT. EBIT is 44,000 divided 22. 2. Right? Combined leverage is nothing but contribution upon EBT. Contribution upon EBT. Contribution is 1,10,000 divided by EBT 22,000.
5.
Right? Next, let's move on to the next sum, guys. Let's do the 11th sum first. Let's see the 11th sum. They've given you that calculate the earning per share for solid and sound from the following data. Now, first let's make the table. Sales less variable cost will give you contribution, less fixed cost will give you EBIT, less interest will give you EBT, less tax will give you EAT. Right? Now let's see this. They said that calculate the earning per share. They've asked you to calculate the EPS. for Sound Limited and Solid Limited, they've given you that assets of Sound Limited are 100 lakhs, assets of Solid Limited are 100 lakhs, assets of Sound Limited are 100 lakhs. Debt in the case of Sound Limited is 50 lakhs at the rate of 12%. Equity is 150. Assume 50% tax in both the cases, right? Now, they give you 50% tax in both the cases. Now, in the case of 20%, the first thing they are saying that 20% before tax return on assets. Now, my total assets, let's see this Sound. No, I'll do Solid. I'll do Solid and then I'll do Sound also. I thought I'll give you Sound for you to practice. Now, they said that your profit is given to you, EBIT is given to you as 20% before tax rate on returns on assets. Now, my total assets in the case of Solid is 100 lakhs. They are saying that 20% on assets. So, if I consider at the rate of 20%, my EBIT will therefore be 20 lakhs. Have you understood how I got 20 lakhs? My total assets, look at your assets of Solid Limited. Assets of Solid Limited are 100 lakhs. They are saying that the earnings is 20% before tax rate and returns on assets. So before interest and tax, your EBIT is given to you as at the rate of 20% will be 20 lakhs, and at the rate of 10% will be 10 lakhs. Similarly, in the case of Sound Limited, at the rate of 20% and at the rate of 10%. Now, in the case of Sound Limited, also your total assets are 100 lakhs. Total assets are 100 lakhs. That means this is going to be 20 and this is going to be 10. Okay. Now, in the case of Solid Limited, there is no debt. Since there is no debt, there will be no interest in the case of Solid Limited. In the case of Sound Limited, there is a debt of 12%. There is a debt of 50 lakhs at the rate of 12%. Someone please calculate 12 plus 6. So in that case, my EBT here will be 20, 10, 14 and 4. Tax rate is given to you as 50%. Tax rate is 50%, so 10, 5, 7 and 2. In which case your EAT will be 10, 5, 7 and 2. Right? Now, there is no preference shares. Less generally we have to do preference dividend. There is no preference shares that will give you amount available. Amount available to the equity shareholders is 10, 5, 7 and 2. Right? Amount available divided by number of shares. Now let's see this. In the case of Solid Limited, your equity share capital is of 100 lakhs and each share is of 10 rupees. So how many shares will you have? You will have 10 lakhs. You will have 10 lakh shares. Everyone's understood how I got 10 lakh share? Equity share capital is 100 lakh. Each share is of 10 rupees. 100 divided by 10, that gives you the answer. Now similarly in the case of this was in the case of Solid Limited. In the case of Sound Limited, your equity share capital is 50 lakhs of rupees 10 each. So that will be 5 lakhs. Hence, your EPS here will be 1.5. Someone please calculate this.
1.4.
1.4 and this
2.5.
2.5.
0.40.
0.40. Right? Okay. So in that case, you will get your EPS as 0.40. Fine, do we get this in here? Now, once you have this, then you have to calculate, they've asked you to calculate, guys, financial leverage. They've asked you to calculate financial leverage, right? Financial leverage is nothing but EBIT upon EBT, right? Financial leverage. In the case of, this is your EBIT is 20 upon EBT. Now in the case of Solid Limited at the rate of 20%, it will be 20 upon 20, that is 1. In the case of Solid Limited at the rate of 10%, again it will be 1. In the case of Sound Limited, it will be 14 upon 20.
1.42.
1.42 and 10 upon 4?
2.5.
2.5. Right, do we get this thing clear? Okay, that finishes that sum. Let's move on ahead, guys. Let's see sum number 14.
So we need to give comments also on this.
No. If they ask you, yes, right? The smaller the leverage, the better it is. What is leverage? Leverage is a form of loan. The less the loan you take, the better it is.
So but उसमें हम लोग को पूछेंगे कैसे कि क्या comment?
Give comment. Is it a risky situation or a safe situation? The closer it is to zero, the more safer it is. The higher the number is, the more risky it is. Right? Let's see question number 14, guys. They've given you data for two companies. They've given you data for S Limited and G Limited. They've given you equity share capital, 10% debentures, and total capital employed. They've given you sales, variable cost, contribution, fixed cost, EBIT, interest, and EBT. All the data is given to you. The following is the information of S Limited and G Limited. Compute operating leverage, financial leverage, and combined leverage. They've given you under two conditions. S Limited is given to you under two conditions, condition 1 and condition 2, and G Limited is given to you under two conditions, condition 1 and condition 2, right? Now let's start this. Let's see this operating leverage. Operating leverage is nothing but contribution upon EBIT. Contribution upon EBIT. In the case of first condition, if you look at the sum, contribution is 1 lakh, EBIT is 50, so this is going to be 2. In the case of second condition of S Limited, contribution is 90 and 40,000. Someone please do this.
2.5.
Excuse me?
2.25.
2.25. Fine. Next, in the case of G Limited, contribution is 1 lakh and contribution is 1 lakh and EBIT is given to you as 50. So that is going to be 2 and 90,000 and 40,000. This is again 2.25. So you calculated for all the conditions, you calculated the operating leverage. Next, you have to calculate financial leverage, which is nothing but EBIT upon EBT. Right? Now, EBIT upon EBT. Let's see this. EBIT in the case of S Limited is 50,000 and 41,000. Someone please tell me.
1.21.
1.21. In the case of S Limited condition 2, it is 40,000 and 31,000. 1.29. Next, in the case of G Limited, it is 50,000 and 49,000.
1.02.
1.02. In the case of G Limited, second condition 40,000 and 30,000.
1.02.
1.02. Both the cases are 1.02.
Yeah.
Next, let's find out combined leverage. Combined leverage is contribution upon EBT. Contribution is given to you as 1 lakh, EBT is given to you as 41,000.
2.43.
2.43. Next, in the next case,
2.9.
2.9. In the next case,
2.04.
2.04. In the next case,
2.5.
2.5. Right? Next, they have asked you to calculate the three leverages. We calculated the three leverages. They have also asked you to find out the impact on the shareholders' wealth. Impact on the shareholders' wealth, that means I need to calculate my EPS, right? Now, I presume that they have already given you the EBT. In all the cases, this is say 1, point number 2, point number 3, point number 4. EBT is given to you. EBT is given to you as 41,000, 31,000, 49,000 and 39,000. Right? Do we get this thing here? Now, let's see this. I don't think they've given you the tax rate in the sum. The tax rate is not given to you, therefore you can calculate PAT. 41,000, 31,000, 49,000 and 39,000. Right? Tax rate is not given to you. Right? Once you have this, then divide it by the number of shares. Wait, before that you need to know preference dividend. Preference dividend is not given to you. There are no preference shareholders. The sum doesn't show you any preference shareholders. So in which case, this will give you your amount available. $49,000, 39,000. Right? Okay. Divided by number of shares. Now in the case of S Limited, my equity share capital is 10,000 and each share of 10 rupees, so 1000. In the case of G Limited, your equity share capital is 90,000, each share is of 10 rupees, so 9,000.
41.
This will give you EPS. Someone please tell me how much
41.
is this? 41.
31.
31.
5.44. 4.33.
Right? So that will be your impact on the shareholders' wealth. The EPS will be highest in this condition. Right? Next, let's see sum number 15 lakhs. Now, you are required to calculate. They said that Zoro Shirts has a sales of 980.2 crores and the other financial data is given to you as follows. They have given you that, let's first make the table. Sales less variable cost gives you contribution, less fixed cost gives you EBIT, less interest gives you EBT, less tax gives you EAT. Right? Let's see this. They've given you that Zoro Shirts has a gross sales of 980.2 crores. Now, they've given you net worth of the company is 152.31, borrowing is 165.47. They've given you that EBIT is 43.17. EBIT is given to you as 43.17. Interest is given to you as 34.39. Interest is given to you as 34.39. Okay, and fixed cost is given to you as 118.23. Right? Let's try to work this out, people. Now 43.17 minus 34.39 should give you 8.78. Right? Since I'm moving upwards, I will have to reverse the process. So 118 plus 43. 118.
161.40.
161.40. Now again you are moving. They've given you sales. They've given you contribution. When you subtract the two, you will get variable cost. Someone please get me the variable cost.
818.80.
So your table is complete. Now they've asked you to find out debt equity ratio. The first thing they've asked you to find out is debt equity ratio. Debt equity ratio, as the name suggests, is nothing but debt upon equity. Debt. How much is debt? Debt is, if you look at the sum, they said that borrowings is your debt. So your debt is 165.47 and your equity is given to you, that's your net worth, which is 152.31. So when you divide the two, that will give you your debt equity ratio.
1.09.
1.09. You can write it, since it's a ratio, you can write it as 1.09:1. Next, interest coverage ratio. Interest coverage ratio. Interest coverage ratio is nothing but EBIT upon interest, right? EBIT is 43.17 divided by interest 34.39. So please help me calculate this. This should come out to 1.25. 1.26. Next, they've asked you to calculate operating leverage. We already know how to do this. Operating leverage is contribution upon EBIT. Contribution is 161.40 divided by EBIT 43.17. Someone calculate this.
3.74.
And then the last thing that you have is financial leverage. Financial leverage is EBIT upon EBT. EBIT 43.17 upon EBT 8.78. Someone please calculate.
4.72.
Excuse me?
4.72.
4.72. Right? So those are all the ratios that you have to calculate for this, right? We'll stop this here for the day. Thank you very much.